Ladies and gentlemen, from that short breather right there, my name is Anthony Sabali and I'm your host for Financial Markets, here to give you the latest news, the latest information concerning both capital and money markets in Uganda, the region, the continent, and the globe as well. Now, this morning, we have news coming in from the Uganda Bankers Association, and we are seeing that they have elected a new chairperson. That is a chairperson of the Uganda Bankers Association. This person is called Arapta Sarah. She is the Citibank Chief Executive Officer and is now the new Uganda Bankers Association head. She takes over from Mr. Matthias Katamba, the DFCU Bank Managing Director, who has been serving in the same role as chairperson since 2020. In a statement, Ms. Amito, the Uganda Bankers Association Head of Communications and Corporate Affairs, said Ms. Arapta Sarah had been elected by the members of the Uganda Bankers Association annual general meeting last week. Other members elected on the board, he stated that they were Mr. Julius Kaketo, who is the Post-Bank Managing Director and will serve as the Vice Chairperson, as well as Mr. Shem Kakembo, the EFC Uganda Chief Executive Officer, who will serve as the Treasurer, and Mr. Raj Kumar Meena, the Bank of Baroda, Uganda Chief Executive Officer, was also elected in the position of Auditor. Now, others who were elected in the positions include Mr. Olalekan, the Guarantee Trust Bank Chief Executive Officer, Mr. James Onyuta, the Finca Chief Executive Officer, both of whom will serve as committee members. Mr. Katamba, who is the outgoing chairperson, noted that the banking industry had and continues to facilitate activities in all sectors of the economy by providing a range of relief measures and interventions to support growth and recovery of the economy post-COVID-19. The banking sector, he added, continues to accommodate sectors such as education and hospitality, which remained under lockdown much longer, by putting in place mechanisms to enable supervised financial institutions to continue providing credit relief till the end of September 2022. Now, the Uganda Bankers Association has over the year worked towards achieving a better banking sector, better banking industry as well, through emphasizing good ethical conduct, lobbying internationally accepted regulations and policies. And during the period between 2019 and 2021, Mr. Katamba said that the Uganda Bankers Association been able to submit regulatory reforms reports to Bank of Uganda with key recommendations to improve operating environment for financial institutions, deliver the electronic Know Your Customer, that is the EKYC, stroke access to NERA databases, and establish the Green Finance Academy in partnership with Adelphi to provide technical capacity building support to financial institutions in the small and medium enterprises. So that is a story coming in there from the bankers. If you know your bank and you know it's part of the Uganda Bankers Association, your new boss now is Miss Arapta Sarah from Matthias Katamba, who has been the chairperson since 2020. That is a story right there making headlines. And now moving on to another story, it has been found that in Uganda, women actually avoid borrowing more than men. That is a report from Bank of Uganda. Women are slightly cautious than men when it actually comes to unnecessary borrowing, according to the Financial Capability Survey. However, the survey indicates that women are less effective when it comes to timely paying of bills compared to men. So yes, women don't take a lot of loans, but when it comes to paying back, they are also a problem compared to men. The findings are contained in a 78-page report compiled by the Bank of Uganda in collaboration with Alliance of Financial Inclusion. The contents of the report, which were compiled during the period ended December 2020 and published on April 13th, highlight that a number of key financial parameters, among which include household incomes, insurance uptake policies, and financial management, among others, are taken up more by men rather than women, which is quite worrying as well. So from the survey, according to the report, over 98.7% of women will avoid unnecessary borrowing when faced with a shortfall, compared to 98% of men. So overall, the report says that 98.5% of adults in Uganda will avoid borrowing. So there's the issue of borrowing as well comes in here, because we can, sometimes loans, like we were talking about yesterday with Mr. Tony Mugisha, loans sometimes necessity, but loans can be a burden to you, and you can die in debt crisis if at all you don't manage your funds well. So I think this report portrays the fact that Ugandans are actually, especially the men, are good at borrowing unnecessarily, and this is very, very bad for an individual, but as well as for the economy, because if you borrow unnecessarily, then you will fail to pay back, and sometimes that can be a challenge on your side, as well as the side of your family, and as well as the economy at large. So just like according to Dr. Susan Kavuma, who is an economist from the Makerere University School of Economics, yesterday said that whereas the difference is negligible, the fear of unnecessary borrowing might be resulting from the fact that women are risk averse. Risk averse means women are not willing to take risks. They are not as willing to take risks as men are, while they don't have the required collateral. So some women don't borrow because they don't have the required collaterals. They don't have the securities for those loans. Additionally, she said, among many women in Uganda, they have not yet attained a certain level of bankable projects required by banks to advance loans. The survey, which is the second edition in the bid to shape appropriate policies by understanding the financial capability of Ugandans, sought to find out how working adult Ugandans use borrowed money, how many are active savers, and how many can trace their finances, and how they can achieve financial goals, and what good budgeting practices they use. So other parameters were how many working adults will avoid borrowing, make considered purchases, and make timely payment of bills, amongst others. The report found that generally working Ugandans are poor at timely payment of bills, with the survey noting that only 28.5% of working Ugandans pay their bills, which is not a good report. If at all you're working and you don't pay your bills, then that is something good, because they'll catch up with you in debt. You will be owed a lot of money at the end of the day. And that is why this show is here, to help you know how to handle that crisis. In case you're in a crisis where you need to raise money, where you need to invest, where you need to save your money, where you need to know your earnings, how to invest them, how to keep some aside for future use, how to invest in life insurance, and so on. This is the program for you, and we can beat this challenge as well. Now, moving on to our other story, it's coming from the Uganda Benefits and Regulatory, Uganda Retirement Benefits Regulatory Authority. Now, the pension-backed mortgage promises affordable home ownership. Now, earlier this week, the last week we have just finished, the Uganda Retirement Benefits Regulatory Authority, as the regulator of pension sector, issued in Uganda, of course, issued new regulations. Basically stated, these new regulations imply that employees that belong to a licensed pension scheme, such as NSSF, the National Social Security Fund, can access mortgages or home loans for purposes of purchase, construction, or renovation of a residential property by using 50% of their accumulated savings as security, as opposed to ordinary residential property. Now, this is very interesting, and I think you need to listen if at all you have been saving for your retirement. They are saying that now the law has been adjusted in such a way that you can use 50% of your savings as security to access a loan that is used, a mortgage loan, a home loan, meaning a loan that you're going to use to probably construct a house, a property, or something that you want to do actually on your piece of land. So you can access this loan and actually use 50% of your savings. So you can use that 50% as security, which is a good thing as well. So you don't need to put another house so that you can build another house. You can just say, you know what, I have my savings with NSSF or any other scheme in which you're saving, so long as it's regulated by the Uganda Regulatory and the Uganda Retirement Benefits Regulatory Authority. You can use 50% of your savings as security, so as you can acquire a home loan, a mortgage loan, so you can have yourself a home before you retire. The context behind these regulations is based on the premise that the main goal of public pension schemes is to supplement the income of citizens and of course to furnish a comfortable standard of living for life after retirement or in case of career halting events. A home can provide an added welfare benefit for individuals and society that oftentimes goes beyond the market value of the home itself. Universally, home ownership has been associated with better health outcomes and a greater access to necessity. So they're saying, why are you saving for your retirement? You're saving in order for you to have a comfortable retirement. But now you're not having a comfortable, you're not having a comfortable life, and you have your savings. You don't have a house, you don't have where you're staying, you're still renting, you're 50 years old. I think it's a good thing if you can get that loan. If you can get yourself that loan, build yourself a simple house so that by the time you retire, you don't have to hop around rentals anymore. So this is something for you to think about as well, if at all you have been saving with some of these schemes. The new regulation also should be able to spur growth of the mortgage market by offering alternatives for security that are readily available for all employees that save with a licensed pension scheme. The arrangement would also allow for favorable interest rates since banks will have to price them lower than the ordinary mortgages because the cost and time frame to recoup their capital in case of default is much lower. Whereas this move is well intentioned, the regulations only address one element, and that is the factor that impacts mortgage growth, that is security or collateral. There is, however, the issue of affordable housing. It is said that in Uganda, housing deficit stands at 2.4 million housing units, out of which 210,000 units are urban areas and 1.395 million units are rural areas. So meaning they're trying to solve the problem, but there is no means at which they can attain actually solve the other problem, which is bad housing. Yes, we are going to give you money to start your housing and you build your house for retirement, but then there are no structures to help you actually build the house, because some of these units that have been already constructed are not up to standard. Now, for the banking sector, there is an opportunity to create products that support borrowing against pension savings. For sure, these accumulated savings provide a better form of security or collateral, lessening the risks of lending. Of course, now for the banks, this will work because the 50% of your savings for retirement will always be there. So the banks can always get it in case you fail to pay it back. But if at all you're using probably something that is not as liquid as the savings, then probably the bank will have also challenges of accessing that security in case you fail to agree in terms of the paying back the loan. So I think this is a nice move, and if you're out there and you have been saving for your retirement, this is an opportunity for you. You have 50% of that saving. You can use it as security to get yourself a housing loan. Remember, mortgage loans are not for business. They're not for starting business. They're not for taking children to school. Only for getting money to build yourself a home, a decent home. Isn't that good news? I think it is. Now, we are moving into our second hour. But before we go to that, we had an interview with Mr. Sanya. We had a talk about saving. And before we go into our second hour, I would like you to have a look and see what Mr. Sanya, who is a trade manager from the Capital Markets Authority, what he had to say about saving. Let's have that in a little while. We'll be right back. Don't go anywhere.
Sanya, I work at the Capital Markets Authority in the unit of communications, public education, and public relations. Saving is a very, very important thing. Now, when we talk about savings, people think about the money. But saving is more than just the money. Saving is your effort. So maybe you are a footballer and you play the game, you're paid. That effort is some of it that you're saving for the future in the form of cash. So what I'm trying to say is that the beginning of it is that you have to earn. And there are very many ways you can earn. Personally, when I was a child, I looked around at home. People were chewing sugarcane back then. Well, I was born in the 80s, and we used to chew a lot of the sugarcane because there was a scarcity of sugar initially. So I picked some of the cuttings and planted them and began a sugarcane shamba. And as a child, I sold the sugarcanes to the people at home. And I made some money, saved, and bought some clothes. Now I work, I get paid a salary, and I save some of that money. There are very many ways you can save the money that you get. You could open a bank account. You could buy something called a piggy bank. The Capital Markets Authority has been giving out these piggy banks, and we've worked for people who are selling charcoal, those small businesses. We have a lady who saved 1.2 million in about 2-3 months from November to February. So she basically got a bit of the profit she made. 10,000, 5,000, 2,000. Different days were different. She keeps the capital, she puts the profit in here. She never thought she would make 1.2 million, but she did. And she now has a bank account. We have even children who got these piggy banks and did washing cars of neighbors. They made a rota. They did babysitting. In 1 month, they put in coins, they put in paper money, and that is their pocket money. Now, once you save, the capital markets helps you to invest. But before I leave the topic of saving, there are some tips that you need to follow. The tip number one is save as soon as you earn. When you make money, don't eat everything. Save about 20%, of it. Think about some money you put aside. And then the next tip is if you earn money every day, every month, or every year, save the same way. So if you're making money every day, save every day. If you're not sure of what to do with your money, save it until you're sure of what you want to do. The next tip is, challenge yourself to save consistently for a specific goal. Then number 4, save in a group, and make sure you save with a licensed financial company. The capital markets helps you with more than just saving. We also help you with an important thing called investing. So we license what are called collective investment scheme managers. Right now they manage over 1 trillion shillings. So if you open a collective investment scheme account, you are part of that 1 trillion shillings. That makes money every day. Sometimes they make 10% profit. They invest in cash, fixed deposit accounts, shares and stocks. They lend to government, treasury bills and bonds, and every day they make a profit. So one important thing about your money is that you need it to be preserved. Your money is like that sugarcane thing that is going to give you more sugarcanes. If you have 10,000, how do you maintain the 10 while making extra? The extra is maybe the 2,000, the 4,000 you're making profit, so that you eat the profit. The bigger the seed, the more the profit. So if I have 1 million shillings saved or invested with the collective investment scheme is different from having 10 million saved. The profit you get is different. So we need to get that discipline where you can enjoy your seed, your profit, which is what the seed gives you, and keep the initial investment, the initial seed, but then eat the profit. So we have professionals who can help you with that. There are people, you can go to the CMA website, cmauganda.co.ug, and then you can find all these professionals who can help you with that. Once you follow these steps, saving will become enjoyable. Think about the lady who saved 1.2 million in 3 months. Now it's time to pay school fees, so she can easily pick from there and pay these fees. If the money is invested, she can get some profit on that and then deal with that thing, school fees. In these next 3 months, as the student at school, she can keep saving, and then she will have another 1.2. If she saves with the collective investment scheme, there will be some profit, maybe 200,000, and then she sorts that issue. So saving is very crucial for everyone, and it's important to begin as a child. Go on saving, and then the more you save, the more you grow.
Had with Mr. Sanya, as well as Madam Bossa, Mrs. Bossa from Standard Bank Group, and as well from Capital Markets Authority. We are all about helping you save and invest for your future, but as well as for your children and as well as for your family. That is what this show is all about. So now we are going to have a small other interview which we had with Miss Bossa from Standard Bank Group. She was talking about brokerage and licensing and what takes place in a brokerage firm and how they can help you access the capital markets in Uganda. Let's have a look at what Miss Bossa had to say.
Bossa Georgia. I work with SPG Securities, the leading brokerage firm in Uganda, mainly in quality training and sales. If anyone wanted to start investing in stocks, number one thing you need to do is open up a shares account. We call it SCD account, Securities Central Depository Account. This account is free of charge. We only need a photo and a copy of your ID. So when the account is open, that means now you're good to go. You can invest, and the minimum number of shares to start with is only 100 actually. So you may ask me, how much is that? Now let me give an example of Stanbic right now. Stanbic is trading at 24. So if anyone wanted to buy the minimum, it's only 2,500, as low as that. So if anyone wanted to invest in bonds or bills, you're required to open up a CDS account with Bank of Uganda, which will also help you, and you need a primary dealer, of which Stanbic, which we are sister company, is. So you come to us, we open up an account with Bank of Uganda, and the minimum there is only 100,000. The requirements are photos, you need a TIN number, and then a passport photo. Yeah. You can invest in equities or stocks. You benefit in different ways, one being capital gain. When I say a capital gain, what I mean here, you're buying shares when the price is low. When the price appreciates, you sell your shares. Let me give an example. If anyone bought UCL like 3 months ago, the stock was at 6 shillings, but right now as we speak, it's trading between 20 to 21. So it has more than tripled. So that's what we call a capital gain. You buy at a low price. When the price goes up, you sell. And then another benefit are the dividends, because remember, you also own this company. So as long as this company that you own has posted a profit, they will share the profits with you, the shareholders. Dividends are paid annually. Now let me give an example. Some of the companies have already started announcing their financials. Umeme is going to be paying a dividend of 54.1 shillings per share. Uganda Clays will be paying 1.35 shillings per share. So shareholders in those companies are going to benefit, are going to earn. And then another benefiting is called a bonus. Now a bonus, this is where companies have retained earnings, but instead of giving you that money, they're going to retain it for other projects. So what they'll do, they'll multiply your shares, they'll give you a bonus, they'll add your shares at no cost. You don't have to pay for them. Let me give an example. MTN did an IPO and they're giving a bonus. Like for every 10 you'd get 1. Remember, has given out bonuses. Stanbic, most of the companies are giving out bonuses, so your shares are multiplied at no cost. And then another benefit is that it gives you ownership. Really, you're there and then you own this company. Let me give an example of Umeme. Most of us complain Umeme tariffs are so high. So if we are complaining that the tariffs are high, how are we benefiting from Umeme? So we tell you, come buy Umeme, be our owner, so that you also benefit in the way that they're charging you tariff this side, but you know you're also getting what? A return. So it gives you ownership. You own this company. Yeah. And then when it comes to the bills and bonds, there is only one way of benefiting, and that's interest. The government will pay you back an interest. So you lend it money, they'll stay with your money, and then they'll pay you interest. For the bonds, since the long term, the government, all these corporate companies will not stay with your money for long. So what we'll do, after 6 months, they'll pay you a coupon.
Well, that was Miss Bossa from the Standard Bank Group brokerage firm, which is in charge of brokering several financial services to you, especially buying stocks or equities from the Uganda Securities Exchange, as well as from other exchanges across the globe. So that was it, a bit of recap for you to understand how to actually invest in some of these schemes and what you can do to get started. Now we're going to go for another short break, but when we return, as I promised, we have an official from Sanlam Group who is here to give us a little bit more about the you want to understand more and more. So you can start with as little as you earn, the little money you earn, you can start investing with it. We are going to go for a short break, but when we return with more of your financial markets advice and all you need to know. Don't go anywhere. We'll be right back.